Assalamu alaikum and hi everyone. Hope you are fine and good. Today, I would like to continue Chapter 10 Standard Costing and Variance Analysis, Part 3, Week 16. Learning objective for today. First, we continue Variance Analysis 10.5, which is Overhead Variance. Under Overhead Variance, we are looking at expenditure and efficiency variance for variable overhead, volume and budget efficiency variance for fixed overhead. Number 2, implication of variance analysis 10.6. For this week, variance analysis, we are focusing on variable overhead variance and fixed overhead variance. The variable overhead variance is comprised of two variances, which are A. Expenditure variance, B. Efficiency variance. For expenditure variance, the difference between variable production overhead expense incurred during a period and the standard variable overhead expenditure. Efficiency variance, difference between standard number of manufacturing hours and the actual hours worked during the period. Reasons for a favorable variable overhead expenditure variance may include economies of scale. Example, increase in order size of indirect material leading to bulk discount on purchase. A decrease in a general price level of indirect supplies, more efficient costs. Meanwhile, reasons for an unfavorable variable overhead expenditure may include a rise in a national minimum wage rate leading to a higher cost of indirect labor, a decrease in the level of activity not fully offset by a decrease in overhead. Reasons for favorable variable overhead efficiency variance may include use of a raw material which is easier to work with, employment of a higher skilled labor, or improvement of skill of existing workforce through training and development leading to improved productivity. Otherwise, reasons for unfavorable variable overhead efficiency variance may include use of a cheaper raw material, which is harder to work with, inefficient production costs by the employment of lower skilled labor. The fixed overhead variance is comprised of two variances, which are A. Expenditure variance and B. Volume variance. Fixed overhead expenditure variance, also known as a fixed overhead spending variance, is the difference between budgeted and actual fixed production overhead during a period. Fixed manufacturing overhead volume variance quantifies the difference between budgeted and absorbed fixed production overhead. Reasons for a favorable fixed overhead variance may include A planned business expansion, which was anticipated to cause a step increase in a fixed overhead, not being undertaken during the period. Cost rationalization measure carried out during the period aimed at reducing fixed overhead by elimination of inefficiencies, for instance, through process re-engineering and optimization of the usage of shared resources and facilities. Next, reason for unfavorable fixed overhead variance may include expansion of business undertaken during the period, which was not taken into consideration in the budget setting process, causing a step increase in the fixed overhead. Inefficient fixed overhead management, example, due to empire building pursuit of senior management. Now, look at variance implication. If actual cost is lower than the standard cost, we get favorable. Otherwise, if actual cost is higher than standard cost, we get unfavorable. Who are responsible for the variances? First, for direct material price variance, purchasing department. For direct material quantity variance, production department. For direct labor rate variance, human resource department. For direct labor efficiency variance, production department. For variable overhead expenditure variance, production department. For variable overhead efficiency variance, also production department. For fixed overhead expenditure variance, manufacturing department. And for fixed overhead volume variance, production department. Please answer this question. Number 1, give 2 variances for variable overhead. Number 2, give 2 reasons for a favorable fixed overhead variance. And number 3, who are responsible for direct labor efficiency variance. That's all for today. See you next.